You ever wonder what might catch the IRS's eye in reviewing tax returns? Today we're going to look at the 5 biggest audit reasons that the IRS uses to review your tax return. Red flag number 1 is unreported income. Now the IRS is going to get copies of your W-2s and your 1099s and 1099Ks, and if you don't report that income, then of course they're going to review your tax return. So the W-2s are pretty obvious. We report those, the IRS gets a copy of it, but the 1099s might not be as obvious. And so if that income is reported, we must include it on your tax return. So if you have a small business, you got to make sure all your 1099 income is captured on your business return, whether it's a Schedule C, a 1065, or even a 1120S. And we have to capture all that income. If we underreport income and your 1099s are greater than that, it might trigger an audit. Red flag number 2, excessive deductions relative to income. Take for example, I have a W-2 wage. It's a decent wage. I make $100,000 in my W-2 income, and I have a side hustle where I make $10,000, $20,000. Maybe I'm trying to kickstart a business or something. If I expense those things out because of startup costs or travel or training, not really a big deal because I'm showing $100,000 in wages. But say I don't have wages and I have a $100,000 business, and I expense those all the way down to zero, but I still obviously have a house, I probably have a car. It doesn't really make a lot of sense if I have a tax return that claims zero income and I really do have a lifestyle that is obviously greater than zero. So we want our deductions proportionate to our income. So take for example, I have 2 clients. One client makes $250,000, but they travel because they're a social media influencer. So they travel, they go nice places, but it all supports their social media marketing company. I can expense all those travel expenses and take their $200,000 down to say $150 or even $125. They're still claiming a significant amount of income that shows how they support their lifestyle. Say I take that same person and their only income is $50,000 and we expense that down to zero. They're not showing any income, they're not showing any way to support their lifestyle. So we want deductions that are proportionate to what we're claiming oftentimes. Charitable contributions is the same thing. If I have $200,000 of W-2 wages and I give $30,000 to charities, then that makes some sense that you could do that and support that. But if I make, say, $60,000 and I have a $30,000 charitable contribution, then it's a little harder to explain. So generally, we want things to pass the smell test. And I always tell clients, if you're speaking to an IRS agent, can you explain that? Can you explain your lifestyle given the income that you're reporting? And if you can kind of pass those tests, then you're probably fine. You can avoid any red flags. Red flag number 3, home office deduction misuse. The home office deduction is absolutely legitimate, but it has to be a committed space. So if I have a spare bedroom that's clearly a bedroom that I really don't use, it's not really worth the deduction. But if you do have an office space that you do administrative tasks, you can absolutely take that as a home office deduction. And I could have an office away from my home, but we can take a home office deduction if we use that for administrative tasks. I work with a lot of stylists that actually go and do styling and haircuts and coloring for their clients, but they don't have an administration space. So in their home, we have a home office, and we're able to take that home office deduction, and they're able to have another office. So a lot of people think that's a red flag, and it doesn't have to be if you can illustrate that you're doing administrative work in your home office. The other thing I see people miss is like inventory. So if I have a plumber that has to hold a bunch of inventory for their business or do repairs at home, if they have a committed workshop or a space where they keep supplies and tools, we can take that space. So when my clients are questioned on this, it rarely happens, but when they do, we have really strong documentation for the expense, why it's a business purpose, and how the client used that. So we have square footage use, we have why they used it for their business, all the supporting documentation and explanation that you might need to support your home office deduction. Red flag number 4, self-employment income and Schedule C filings. And this is really tied to our red flag number 1, unreporting income. If you report a Schedule C self-reported income and every year there's either no gain or a loss and you have no other household income, that's a big red flag. We don't go years and years and years without having any income And then of course we're driving, we have household expenses and stuff. Now we could have a year where we do have a zero or a loss, and we can do that for a couple years. By year 3, we really want to show income on that Schedule C. So if we have a loss year 1 and year 2, by year 3, we really should show profit, because no one would stay in business year after year after year losing money. It doesn't make any sense. But we could absolutely see a business that maybe brought in $20,000 year 1, $60,000 in year 2, still had losses maybe because of expenses, but by year 3 was up to $100,000 to show profit. And what I really want to see with my clients, and what the IRS probably expects, is that there is some activity even if you're showing those losses. So if you have a business that shows losses every year, it's a hobby. So we've all had those hobbies that we think might be a business. An example might be showing a dog. My daughter would show her dog, and we could have said that was a business. We invested in a show animal, she got prize money, but she really wasn't doing it for a profit motive. And keep in mind, that's really the key when we do Schedule Cs and we would run business and business expenses. There should be a profit motive. And if we lose money year 1, year 2, that's okay. We have a commitment to making a profit. But if we're going into years 3, 4, and 5 still showing a loss, then do we really have a profit motive, or is it just something we enjoy doing, or are we just expensing things for the sake of expensing them? So if we need to show a profit motive when we actually file those tax returns. Red flag number 5, cryptocurrency transactions. With the rise of digital currencies, the IRS is going to be much more active in reviewing and critiquing crypto investments. So it's most important for you as a crypto investor to take diligent records and really have documentation of all your crypto activities. IRS is going to use AI tools to really analyze that these are being reported appropriately and that people are actually reporting their crypto. A lot of people get into crypto because they think it's not being tracked, and they think this is a way for them to invest or make money kind of off the grid, as it were. And although there might be some truth to that, the IRS is definitely in tune to crypto investments, and it's important for you as a tax filer to have good records to support your crypto investments. Understanding these red flags can keep you on the IRS's good side. And I really bring this back to thinking of having an IRS agent next to you, next to us as we complete your tax return. Is what we're reporting, does it make sense? And that's really the biggest thing. Does it make sense that you have a business that makes $100,000 but has $100,000 of expenses, and you have no reported income but have a $500,000 house and a $20,000 car? It doesn't really make sense, at least not for the long term. And maybe it happened for a year because you used your savings to start a side hustle, so that kind of makes sense. But to do it for 5 years, not so much sense. But does it make sense for someone that makes $300,000 to have travel expenses, a home office, maybe they are a contractor and they had to buy a new truck, and so they have real significant expenses, but they have significant income as well. So that $300,000 might get down to $100,000. Well, I could live on $100,000 pretty comfortably. So does it make sense? And we're always going to go back to that. So when I meet with my clients, and if you were to reach out for a consultation, we would really start with building a foundation for reporting and making sure that it makes sense. But what I often find with new clients is that they're not being as aggressive as they could be because they're really nervous about these red flags. And red flags aren't a reason to be nervous or underreport expenses. What they really are is something to focus on and make sure at the end of the day that we have the documentation and the explanation to support why we're taking an expense. So if you have any questions regarding your business or your side hustle, or how to tax plan to mitigate your tax liabilities, be sure to reach out to us here and we'd be happy to help you out.